My name is Robert Tuttle. I'm a reporter with Bloomberg News. I'll be moderating this panel today on Canadian midstream, on the midstream sector. It's fairly well known that Alberta has a problem with too few pipelines to get oil out. But the issue is kind of bigger than that. Very large networks of pipelines, rail lines, and storage terminals are required to not just get oil out of Canada, but to get hydrocarbons into the oil sands themselves. Tight oil and gas producers in Western Alberta, they drill for condensate and gas that must be transported to Northeastern Alberta. There, the gas is used to steam oil sands reservoirs, and the condensate is blended with bitumen to make the crude oil that's then exported. And that oil has to be shipped south by pipeline or rail to refineries as far away as the U.S. Gulf Coast. Now, the recent collapse in oil demand because of the pandemic has sort of thrown this whole system on its head. So we have the representatives of three companies involved in different aspects of this supply chain with us today. First, we have Cameron Goldade. He is Vice President of Capital Markets at Pembina. His responsibilities include corporate development, corporate planning, investor relations, treasury, and cash management. Before joining Pembina, Cameron spent 11 years in energy-focused investment banking. Beth Pollock is Vice President and Treasurer of Gibson Energy. She joined the company in 2015. Prior to her time with Gibson, Beth had over 10 years of experience in investment banking, corporate banking, and consulting for energy sector clients, most recently with RBC Capital in Calgary. Tony Aulicino, I hope, is Chief Financial Officer at CES Energy Solutions. Before joining CES Energy, he was Managing Director of Global Investment Banking for Energy at Scotiabank Global Banking and Markets. He has over 20 years of experience in finance, capital markets, mergers and acquisitions, and coverage of the North American energy services industry. So I'm just going to start by asking each of you to introduce yourselves, if I didn't do that very well, and introduce your companies in particular. So why don't we start with you, Cameron?
Thanks, Robert. No, that was a fantastic introduction, and hello to everyone who's on the webcast. I think maybe just to spend a couple minutes on Pembina. Pembina, for those of you who don't know, is a transportation and midstream service provider. We've been in business for 65 years now, largely serving the Western Canadian Sedimentary Basin, although in the past few years we have expanded beyond that, and we have a few straws now into the U.S. basins. Our focus has always been on integrating our services, so providing multiple services to customers across the value chain. We find that for us is a competitive advantage and also enables our customers security and timeliness of service. We also focus on getting our customers' products to the highest netback markets in the world, whether those be locally or throughout the world. This has been fundamental to our strategy over time and has been a large part of the enabler of our growth. From a financial perspective, I would characterize Pembina as a conservative and diligent company. We pioneered the financial guardrails for our company back in 2016, which are really the promise for which Pembina makes to its investors in terms of how we'll approach different aspects of the capital structure and the financial makeup of our company as we go through cycles and capital projects. I'll talk more about those, no doubt, in questions, but that's a good snapshot of Pembina.
Thank you, Cam. Anthony, how about you?
Sure. Thanks a lot, Robert, and thank you to Bloomberg for including us in this panel. Just so everybody knows, CES Energy Solutions is actually a manufacturer of chemistry used primarily in the energy industry. So we're not as much of a midstream player as Pembina or Gibson. However, half of our revenue is related to production-related chemistry, which is very much recurring and has very similar cash flow attributes to the midstream revenue and cash flow streams of the midstreamers. So we are headquartered in Calgary. We manufacture chemistry that gets used to solve problems for the producers while they're producing oil and gas streams and while they're drilling for new wells. And that chemistry is advanced. It's manufactured through a vertically integrated business model where we buy raw materials primarily from Asia and some Europe and North America. We get those basic molecules. We react them under temperature and pressure profiles, and then we sell them to our customers to solve their problems and to make their production and drilling activities even more economical. About half of our revenue is production related. Revenue in 2019 was 1.3 billion Canadian. About 75% of that was in the US, where we have a very strong presence in the most prolific basins, including the Permian. And obviously in Canada, very strong presence in the Deep Basin, North Montney in particular, and the oil sands. So when we look at the business, we're CapEx light, asset light, which makes our cash flow generation very strong and gives us some of those defensible midstream-esque financial model attributes, which has been attested by the rating agencies that cover us, where we were one of the only energy service companies in North America to be reviewed during the COVID downturn and not be downgraded. So both S&P and DBRS maintained their ratings that were in place pre-COVID based on our cash flow business model.
Thank you. Yeah, that's interesting. How about you, Beth? Tell us about Gibson.
Thanks, Robert. And also thank you and Bloomberg for having me here today on behalf of Gibson to share a little insight into our company. So Gibson is an oil-focused infrastructure company. We did undergo a significant transformation of our business over the last 3 to 4 years, which some people watching today will probably be familiar with. But today we see ourselves as having among the highest cash flow and one of the strongest financial positions among our energy infrastructure peers. The transition of our business greatly improved our credit profile and culminated also in 2 investment grade credit ratings in 2019, something we're very proud of. From a cash flow perspective, 80% of our business is from our infrastructure segment. And this is really underpinned by take or pay or stable fee for service structures. As we think about our infrastructure business, the bulk of it is terminals. These are at Hardisty and Edmonton in Alberta. We have 12 million barrels of storage in Hardisty, and we have just under 2 million barrels in Edmonton. Hardisty is also, I think it's noteworthy to say, going to be the site of our diluent recovery unit, which we're building right now with the partner that we have in our rail facility and for our customer ConocoPhillips. This is going to be the first of its kind in Western Canada and a very exciting endeavor for our organization. And outside of terminals, we have a network of gathering pipelines. We have a Moose Jaw facility, an emerging position that's quite small in the US, and a marketing organization which optimizes our infrastructure assets and also markets the refined product from Moose Jaw. To echo, or maybe we're following in Cam's footsteps here, but having a strong financial position is also very important to us. We have and manage our balance sheet in accordance with our financial governing principles. Might sound a little familiar from his financial guardrails. But we've got leverage right now of 2.4 times, which is actually below our target range of 3 to 3.5, which really reflects our bias to be conservative and be at the low end of that range.
Oh, thank you, Beth. I guess I'll start by asking, I mean, the obvious thing that's going on now is that the oil and gas industry has suffered a huge loss in demand like no other time in recent history because of this pandemic. Here in Canada, more than 1 million barrels a day of production came offline. Anthony, I mean, your company works with drillers, and that sector has been particularly hard hit, requiring some tough steps, I'd imagine. How did you guys adjust, and how did you do adapting to this situation?
Yeah, that's a good question. So we, number one, our company, just like the companies of my peers, have been through these downturns before, 2008, 9, 2015, 16, and we're currently in this downturn that we are getting through. So the way we coped with it was, number one, we came into it with a very strong balance sheet, which ended up being a significant competitive advantage. And working with the drillers and that volatile part of our business that represents about half of our revenue, we know very well. In Canada, as the audience may or may not know, it's already very seasonal. So we are very comfortable with adjusting our cost structure, which we did very quickly in both Canada and the United States. So we were able to remove about 25% of our employee-related costs, personnel-related costs, very quickly on an annualized basis. And that allowed us to bring our cost structure down. And then the next thing that we did, because our drilling business is working capital intensive, really focused on optimizing that working capital. And what should have been a very big weakness ended up being a strength. We were able to harvest over $116 million of working capital just during Q2, during the depths of the downturn, and went from a draw on our senior credit facility to a cash position of $40 million when we reported Q2 in mid-August. So it's something that we've seen before. We acted very quickly on. We have a very strong balance sheet. We have a resilient balance sheet that allows us to harvest that working capital, which puts us in an enviable position to act aggressively while many of our competitors are falling by the wayside.
Yeah, thank you, Tony. That's interesting. Cam, you guys are in the you're in the midstream sector. I guess you've seen your volumes affected by this, but still, how are you managing with this downturn, and how's it looking going forward for you guys?
Yeah, thanks, Robert. You're right. For us, the eye of the storm was really in early May. We started when April came on, we started hearing a lot of talk, obviously within the industry, about this concept of tank tops, and a lot of discussion and consideration around that. What we ended up seeing was volumes really hitting a trough in early May and actually recovering quite well through the latter half of May into June and July. I think it's important for the viewers here to remember that, the summer months are typically a seasonally softer period in any year for volumes in Western Canada, largely due to the winter predominant drilling that occurs. And so most of our customers, or many of our customers, are doing their drilling activity in Q4 and Q1. So we see volumes typically increase in Q1, soften through the year, and increase again in Q4. And this year appears to be no different, notwithstanding the dislocation we've seen from COVID. But broader than that, I think what we've observed from our company is twofold. One has always been a focus on the geology underpinning the assets, or underpinning our customers. And for us, we've heard our CEO say that if we had to rebuild our assets again, we would build them in the exact same place, because they sit on top of some of the most prolific geology in North America. We have that benefit. We also have the benefit of some strong contractual underpinning. For our business, approximately 70% of our earnings come from contracts with our customers, which are either take or pay in nature or cost of service in nature, meaning we have volume protection or downside protection through those contracts. And as a result, with where our customers were before the COVID pandemic, we were generally running, just above those take-or-pay levels in most of our businesses with that commercial construct. And so what it really did is create a bit of a floor for us in the near term and offer actually some interesting operating leverage coming out of this pandemic as we start to see volumes recover. So we were very pleased with how we persevered through this. We made a prudent decision to defer some capital to preserve our own financial strength as well as the strength of our customers and the safety of our communities around that. And coming out of the back of this, we feel quite happy with where our customers are sitting from a financial perspective and where Pembina is as well.
Thank you. That's interesting. Well, Beth, I mean, your company is very significantly in the storage business. And we all saw how storage tanks and everything else that could hold oil filled up to capacity a few months ago. I think from looking, you had a very strong second quarter in terms of cash flow, and marketing arm did well. How has this downturn been for you guys?
Well, for Gibson, we were certainly very pleased with the Q2 high water mark of 94 million. It was a strong quarter for us and really allowed us to strengthen our balance sheet and continue to enhance our credit metrics. That being said, when we look at COVID, the impact really was modest to our company and reaffirmed that successful transition of our company that I mentioned earlier. It showed that we were well positioned to withstand challenges facing the sector. Similar to what Cam said, we did see volumes come off in May, but we saw them come back online by the end of June. So all in all, on the whole, our Q2 results were in line with Q1 pre-COVID. Where we did actually see some weakness was on the conventional non-oil sands part of our business, but this really only comprises about less than 5% of our overall business. And volumes here were about half of what they were pre-COVID and have been quite slow to recover. Notwithstanding this strong quarter, though, we still take a very conservative approach to our planning processes. And we're still looking at it in terms of the run rate marketing levels of 80 to 120 million. And this is where we're fully funded and comfortable we can deliver. In terms of actual capacity at our tanks, as I mentioned earlier, most of this is contracted tankage and it's used by producers for operational purposes. And so for that reason, we didn't have space to provide to people for opportunistic short-term tank opportunities. And for that reason, we had the stability that we did. But at the same time, our marketing division is actually able to use tankage, which they do in the ordinary course of business, whether or not it's at Hardisty or Edmonton or Moose Jaw. And they did, and they were able to take advantage of that contango curve. And that's what we really saw reflected in our results.
Okay, well, thank you. That's interesting. I guess I want to look south now a little bit. There's two things happening there's two things I want to ask about the U.S. Obviously, if we see a Biden presidency, in recent years, the Canadian energy space have kind of been seen as disadvantaged from a regulatory tax perspective versus our southern neighbors. But with the Biden presidency, there could be a new focus on environmental concerns. He's pledged to stop fracking on federal land, pull the permit for Keystone XL. We could see slowing of permitting for pipelines, LNG terminals, and obviously, Tony, you're in both sides you work in both areas. I mean, what do you expect from if there's a change in administration in the U.S. for the business? And what does it mean for Canada also? Will Canada be more attractive now?
Yeah, so just starting off with the US and this concept of politics. Politics are politics, and we've already seen some backtracking by the Democratic Party from the one extreme, which was a total ban on fracking, to now they're talking about potentially limiting or eliminating fracking on federal lands. So it's very difficult to pinpoint exactly what's going to happen in the near term, because the reality is nothing is going to happen in the near term. But there will be a shift in policies for sure. So just focusing on some of the most concrete statements, which have really revolved around a limit or elimination of fracking on federal lands. When we look at a company like ours, CS, we in fact generate about 90% of our activity in the US drilling market from private lands, not federal lands. So the effect of something like that on us would be way less pronounced than perhaps some other players. And the other thing I would add to that is these producers, if there's an economic model, will still need to drill and frack and produce, and they're going to do it on private lands. And those are places that we're at already, because that's where most of our activity is. And we're very good at it because we spend a lot of our time there. So we're not so fussed by what we know is quasi-concrete. However, there is a wild card in the medium to long-term policy changes as they relate to clean energy and acting on fossil fuel-related policies. And that kind of thing takes months, if not years, to unfold. So we'll act in accordance as they unfold. And in Canada, Canada still, from a production perspective, has something that the U.S. needs and U.S. refiners need, and that's heavy oil. Those refineries are designed to take that, and it would be very expensive and cost prohibitive to change them. They've lost a lot of supply from places like Venezuela and Mexico, and as a result, need what we're able to provide them. Unfortunately, we have to do a lot of it by rail right now, but we expect saner minds to prevail and revisit the safety aspects and the efficiency aspects of those pipelines.
Thank you. And Cam, I mean, as a midstream company, I actually kind of want to pivot this a little bit. You guys had acquired the Kinder Morgan's assets in Canada recently, and I'm kind of wondering, like, do you see opportunity to expand in the U.S. in terms of acquisitions? I think Canadian midstream companies tend to be a little healthier on their balance sheets than their U.S. counterparts. Do you see some opportunities there?
Yeah, it's a good question, Robert. You know, the U.S. is always interesting because obviously there is some very prolific geology in the lower 48. You know, things like the Permian and the Bakken are definitely clearly world-class geology. You know, Pembina today has a small position in the Bakken. You know, sort of through our pipelines, the Advantage Pipeline and the Alliance Pipeline that service in some way, shape, or form those basins. You know, the challenge for Pembina has always been, when we've looked in the U.S., you know, just on a screening basis, you're always looking around at what's available. What we've observed is that the commercial structures, notwithstanding that the geology is very strong, just haven't stacked up quite as robustly as those that we're used to in Canada. You know, I talked about in my early comments our high take-or-pay percentage. You know, in past, that just hasn't really matched what we've seen in the U.S. And so, notwithstanding the valuations that are occurring in the U.S. right now, it's just hard to see that risk proposition in this environment.
Okay, thank you. And Beth, I guess you'll be. What about you guys? What opportunities do you see down there? We just have about a minute left, so.
I think if I think about the different questions you've asked here, as we look at the outcome of, or the potential outcome of the U.S. election, which obviously we wouldn't even endeavor to predict, I think Gibson's in the fortunate position of having visible growth, regardless of who's elected and regardless of what occurs with pipelines, for example. There's a significant opportunity for a DRU project in rail, which Anthony alluded to, should the pipelines not proceed. If pipelines do proceed, there's a lot of opportunity with respect to tankage at Edmonton and or Hardisty for our organization. In terms of acquisitions, as which you had spoken about with Cam, we just completed transformation of our business, which included a significant effort to clean up the impact of various acquisitions. And so that's not something we're looking at doing. We're quite comfortable with the organic growth and building at a 5 to 7 times multiple versus paying somebody for work that they've done.